Hello friends, today we are diving into the Gatheral and Jacquier paper on arbitrage-free SVI volatility surfaces. This is one of the most practically important papers in quantitative finance. It solves a problem that practitioners had wrestled with for over a decade. How do you fit an implied volatility surface that looks good, prices all your options correctly, and is guaranteed not to admit a static arbitrage? In this notebook, we will build everything from scratch: the raw SVI smile, the SSVI surface with multiple phi functions, the arbitrage diagnostic functions from the paper, and the calibration routine with the crossness penalty. We will see the Vogt example, the pathological SVI smile from the paper, and watch the algorithm fix it in real time. Each piece of code follows directly from the paper's mathematics. We use our standard scientific Python stack: NumPy, SciPy, and Matplotlib. We will need SciPy's optimization routines for calibration and its statistics module for the normal CDF in the Black-Scholes formula. The clean Matplotlib defaults give us publication quality figures. Let us move straight to the mathematics. The raw SVI parameterization maps log moneyness K to total implied variance W. Log moneyness is the log of strike over forward. It is 0 at the money, negative for puts, and positive for calls. The 5 parameters each have clean geometric interpretations. The parameter A is a pure level shift. Changing A moves the entire smile up or down. The parameter B steepens both wings simultaneously. The correlation rho tilts the smile. Equity markets typically have negative rho because the implied volatility skew slopes upward toward lower strikes. The parameter M shifts the vertex of the parabola left or right. And sigma controls how cupped the vertex is. Larger sigma gives a rounder, flatter ATM region. Let us implement this and explore how each parameter affects the shape. The 3 panels show the parameter sensitivity of the raw SVI smile. The left panel varies rho, the skew parameter. Negative rho gives a downward sloping implied volatility surface, with higher vol at low strikes, which matches the equity skew observed after the 1987 crash. The center panel varies B, the wing slope. Higher B makes both wings steeper, which you see when implied vol is expected to be high across all strikes. The right panel varies sigma, the ATM curvature. Low sigma gives a sharp V-shaped smile. High sigma gives a rounded, flat ATM region. In practice, equity index smiles have relatively low sigma. The curvature is quite sharp near at-the-money options. The core mathematical machinery for butterfly arbitrage detection is the function g of k. This function is derived from the Breeden-Litzenberger formula, which says the risk-neutral probability density is the second derivative of call prices with respect to strike. When you differentiate the Black-Scholes formula twice and simplify, you get an expression proportional to g times a positive exponential weight. So the density is non-negative everywhere if and only if g is non-negative everywhere. The formula for g involves w, its first derivative w prime, and its second derivative w double prime. The term 1 minus k w prime over 2w is sometimes called the d plus term, and it appears because the Black-Scholes delta has this structure. For raw SVI, we can compute W prime and W double prime analytically, which is what makes this approach tractable. Here we reproduce the exact Vogt example from the paper, a real SVI parameterization found by Axel Vogt on wilmot.com that violates butterfly arbitrage. The left panel shows the total variance smile, which looks perfectly reasonable, a smooth, positively skewed smile. But the right panel reveals the problem. The G function goes significantly negative near k equals 0.5. That red shaded region is where the risk-neutral density turns negative, an outright impossibility. Any trader who priced butterfly spreads using this surface would be exposed to a model arbitrage. The key insight is that the total variance plot gives no visual warning. You need to compute G explicitly. This is why the paper's closed-form conditions are so valuable. They let you avoid this situation entirely without having to scan G over a grid every time you recalibrate. The SSVI surface reparameterizes everything through the ATM total variance curve theta t. This is elegant because theta t is directly observable from market prices for any quoted expiry. You just read off the ATM option and compute sigma squared times t. The function phi of theta controls how the wings of the smile scale with the ATM variance. Think of it as the slope function. It determines how steeply the smile tilts as the ATM variance changes. The Heston-Like phi reproduces exactly the behavior of the Heston model's ATM skew at large maturities, which is the theoretical motivation for SSVI. The power law phi is the practical choice. With gamma equal to 1/2, the product theta times phi of theta equals eta times theta to the power minus 1/2, which gives a constant ATM skew in volatility terms across all maturities. This is an empirical feature of equity implied volatility surfaces that has been documented extensively. The two panels show SSVI implied volatility slices for 5 different ATM variance levels, from 4% for a very short-dated option to 80% representing a high volatility regime or long maturity option. The left panel uses the Heston-Like phi function. Notice how the slope of the wings changes non-linearly with theta. For very high theta values, the phi function shrinks, reducing the wing slope and giving a rounder smile. This matches the Heston model's behavior. The right panel uses the power law phi with gamma equal to 1/2. Here, the relationship is cleaner. The wing slopes scale uniformly as theta changes. When gamma is exactly 1/2, the SVI jump wings parameters, the ATM skew psi t, the put wing slope pt, and the call wing slope ct are all constant across all maturities. This is the theoretical result behind why simple square root of time parameterizations of the skew work so well empirically. Corollary 4.1 assembles the paper's main result into 4 checkable conditions. Condition 1 is trivial if you observe the ATM variance from market prices. It just says longer dated options have more variance, which is always true in practice. Condition 2 involves the derivative of theta times phi with respect to theta. For the power law, this derivative is simply 1 minus gamma, which is a constant. The calendar spread condition becomes just the single inequality 0 less than or equal to 1 minus gamma less than or equal to the upper bound. For gamma in 0 to 1, the lower bound is always satisfied. The upper bound, 1 plus square root of 1 minus rho squared over rho squared, is always at least 1 for rho in -1 to 1, so gamma in 0 to 1 also satisfies the upper bound. Conditions 3 and 4 are the butterfly conditions. They impose an upper bound on how large theta times phi of theta can get. These are the binding constraints that limit how far into the tails the SSVI surface can extrapolate while remaining arbitrage-free. The two panels show the butterfly arbitrage conditions for our power law SSVI surface. The left panel plots theta times phi theta times 1 plus absolute rho against the threshold of 4. For small theta, short maturity options, we are well below the threshold. As theta grows, the product increases because phi grows as theta decreases with gamma equal to 1/2. Eventually, the product crosses 4 and we enter the arbitrage zone shown in red. This tells us the maximum ATM variance for which this power law parameterization is guaranteed arbitrage-free. The right panel shows the second condition, which involves phi squared. This is often the binding constraint. In practice, you simply choose eta small enough that both products stay below 4 for all realistic theta values in your term structure. Alternatively, you use the modified power law with the 1 plus theta damping factor, which ensures both conditions hold for all theta, provided eta times 1 plus rho is at most 2. Now we calibrate SSVI to synthetic market data designed to match the properties of a real SPX implied volatility surface. We generate 8 expiries from 1 week to 2 years with ATM variances and smiles that resemble the volatility term structure you would see in a normal equity market environment. The calibration has 2 steps matching the paper's recipe. First, we feed the global SSVI parameters, rho, eta, and gamma, to all slices simultaneously, imposing the butterfly arbitrage constraints. Second, we verify all 4 conditions on the fitted surface. This is the key practical advantage of SSVI. The global calibration naturally couples the slices and enforces the no calendar spread condition, rather than fitting each slice independently and hoping they do not cross. The 8 panels show our synthetic SPX-like implied volatility surface. Gray dots are the noisy market observations with realistic bid-ask spread noise. Blue lines are the true SSVI surface we used to generate the data. The surface has the characteristic shape of equity option markets. A steep left wing for the short-dated options, high implied vol for downside protection, that flattens out at longer maturities. The ATM variance term structure grows from about 3% for the 1-week option to 40% for the 2-year. Notice how the skew is most pronounced for short-dated options and flattens out at long maturities, exactly what you see in real SPX markets. Our calibration will need to recover the true parameters from these noisy observations. The calibration recovers the true SSVI parameters with high accuracy. The global rho, eta, and gamma are recovered to within a few basis points of the true values. The ATM total variances per slice are also recovered closely, with the largest errors for the very short-dated options where the noise is highest relative to the signal. Critically, the calibration uses penalty terms to enforce the butterfly arbitrage conditions. Any parameter combination that violates conditions 3 or 4 incurs a large additional loss. This is the paper's crossiness penalty adapted for the SSVI setting. The LBFGSB optimizer finds the global minimum efficiently because SSVI has a clean, smooth objective function with well-behaved gradients. The result is a calibrated surface that is guaranteed arbitrage-free by construction. The calibration results are excellent. Blue lines show the fitted SSVI surface, green dashed lines show the true underlying surface, and gray dots are the noisy market observations. The fitted surface tracks both the true surface and the market observations closely across all 8 expiries. The RMSE values in the legend measure the root mean squared error in volatility points. Values below half a volatility point are well within the typical bid-ask spread for index options. Importantly, the global SSVI parameterization naturally couples all slices through the shared rho, eta, and gamma parameters. This coupling is what prevents calendar spread arbitrage. You cannot have a situation where one slice accidentally crosses another because all slices share the same scaling structure. The paper's arbitrage elimination algorithm is practical and elegant. Given a smile that violates butterfly arbitrage, you fix 3 observables that traders directly care about: the ATM variance, the ATM volatility skew, and the put wing slope. These are the most liquid parameters. You then compute the guaranteed no arbitrage call wing as the put wing plus twice the ATM skew and the minimum variance according to the SSVI formula. This gives you a smile that is guaranteed free of butterfly arbitrage, but it may not be the closest possible arbitrage-free smile to the original. The final step optimizes the call wing and minimum variance in the interval between the guaranteed no arbitrage solution and the original parameters, penalizing any butterfly arbitrage while minimizing the distance to the original smile. Let us implement this on the Vogt example. We implement the full arbitrage elimination algorithm from section 5 of the paper. First, we convert the Vogt raw SVI parameters to SVI jump wings form. This gives us the ATM variance Vt, the ATM skew psi t, the put wing slope Pt, the call wing slope Ct, and the minimum variance V tilde t. The guaranteed no arbitrage fix sets C prime t equal to Pt plus twice psi t and V tilde prime t according to the SSVI formula. This gives us the most conservative arbitrage-free smile. It is definitely arbitrage-free, but potentially far from the original. We then optimize the call wing and minimum variance jointly in the feasible interval, penalizing any remaining butterfly arbitrage while minimizing the distance to the original Vogt smile in terms of total variance. The optimal call wing recovered by our optimizer closely matches the paper's reported value of 0.8564763. This is the paper's arbitrage elimination algorithm in action. The 3 smiles show the total variance as a function of log moneyness. The solid blue line is the original Vogt smile, the one with butterfly arbitrage. The dashed green line is the guaranteed no arbitrage smile produced by projecting to the SSVI formula. It is clearly arbitrage-free. The G function stays positive everywhere, but the smile shape is noticeably different from the original. The dotted red line is the optimal no arbitrage smile found by the fine optimization. It sits much closer to the original Vogt smile while still keeping G non-negative everywhere. The optimal solution recovers most of the fit quality compared to the conservative guaranteed solution, confirming that the paper's algorithm finds the best possible no arbitrage approximation to any given parametric smile. The butterfly check at the bottom confirms original has negative G, Both fixed versions do not. To summarize, this notebook implemented the full Gatheral Jacquier SVI framework. We started with raw SVI, explored parameter sensitivities, and saw how the Vogt example admits butterfly arbitrage despite looking visually reasonable. We then built the SSVI surface with two canonical phi functions and verified all four arbitrage conditions analytically, a dramatic improvement over numerical scanning. The SSVI calibration to synthetic SPX data recovered the true parameters with high accuracy and naturally coupled all 8 expiry slices. Finally, the arbitrage elimination algorithm projected the Vogt smile onto the feasible no arbitrage space, finding the closest smile that guarantees G of K to be non-negative everywhere. The core insight of the paper is that the right parameterization makes everything tractable. Raw SVI's 5 parameters resist arbitrage analysis. SSVI's 3 global parameters plus the ATM variance curve yield closed-form conditions that practitioners can check in milliseconds during calibration. Thank you for watching, and I will see you in the next paper breakdown.